The trade desk, okay, the trade desk is currently in a downtrend. Risk analysis, 5 out of 6. Growth has dropped significantly from 31.2% over the past 5 years to 12.11%. And with the trade desk, we have something similar here again. So I would also wait until it comes back down into this area here. You can see it didn't go all the way down here because this is a weekly closing price. So in this chart, we're using weekly prices. And I think during that week, it dropped down to this support level where these levels were here and here. But you don't see that here because by the weekly closing price, it had already bounced back up. All right, so here, I wouldn't enter right now as an entry point. Right now, you just have a downward move and the chance to come back down to this level here. That's another 15%. And if you go in here now, you'll just end up regretting that you could have gotten it 15% cheaper a few weeks later, and your hard-earned money is worth 15% less in your portfolio. So I would definitely wait here for now. London Stock Exchange looked pretty good here in the past. Here we see the growth rate at 16.33%, and the growth prospects are not below average. They're average, so above 10%. The margin of safety is still high, 22%, and then it costs 34%. So that looks good. But look here as well. There was probably just an announcement. Now, I don't know, I didn't have this stock on my watch list or anything, that the outlook is worse, and then it's really justified that the price is dropping here. So just buying in here now could work. It will return to its intrinsic value, but whether that's right here or if it drops even further, that's a bit of a gamble. You don't truly know whether it's going to turn back up right here at this very moment, because here too, this significant sell-off has a very real and undeniable reason, and it's an incredibly important one to consider. Less growth is expected, and that disappoints investors. And others who say, I'm not bothered by less growth, I'll get in, are then outnumbered by those who are disappointed and keep selling. Otherwise, the stock actually looks pretty good. So the risk analysis here is based on past data. From 2021 to 2024, in this case for 2025, there isn't any data yet. That will be published by the company around February because the fiscal year ends in December 2025. We have 33.89%. So based on the analysts and the intrinsic value, you can expect good percentages here. But as I said, this is currently really tricky, and it's just going down right now. You'd have to wait and see. If we take the stock, for example, let's put it this way. If I say to myself, okay, here's the bottom, and it's starting to slowly, gradually rise again from here. Look, that's just about 2%, perhaps even 3%. That's really not that much here. Then you could set a stop just below this last low and really get out if it keeps going down. Now let's take a look at the quarterly figures, October 23rd. That's still a long way off. So for now, we can't really expect any kind of shock moment that would send it down again. And yes, down here we see July 31st, and here that was July 18th to July 1st. Exactly, that's when it dropped here because of the numbers. Already in the week before the numbers, it went down, and then with the numbers, it dropped again here. Yes, if it doesn't drop further here, and the stock shows that it wants to rise a bit, then you could get in if you want to. For me, it's not something I do right now. I'm speaking a bit differently now because I noticed the day before yesterday, we had a beginner meeting. I offer that for clients in growth investing. It's not exactly a Zoom call, but it's like a Zoom call just with Google Meet. And then the clients are there and can ask me questions. And that's when I realized with the stocks I look at, I always have something to criticize because I'm super picky. But that doesn't mean for you that these aren't good opportunities we're looking at here. And I'm trying to express that a bit differently now. So here would be an opportunity. It wouldn't be a buy for me, but anyone who only buys when I would buy usually waits a very long time for a good opportunity. I have 8 stocks out of the 10 I want in my portfolio, and I'm extremely picky about choosing the other 2. And that's why you often hear me say things like, this and that bothers me, but that doesn't mean these aren't still good opportunities for you. Dino Polska, in the quick analysis, we can see here that everything looks pretty good at first, except for the risk analysis, 5 out of 6. One key figure doesn't fit, and according to the EMA 50, it's in a downtrend. So here we have a growth rate over the last 5 years of 30.26%, which is very high. Here we can immediately see profit growth and revenue growth rate. Here 29%, 30%, so it's nicely distributed. It's not all just profit. And the growth prospects for the current year at 17.12% are already much lower, but still above average. Safety margin is 21.74%, which also looks good. Then here we have 8.34% according to analysts, which is not that high anymore. And then let's take a look here at the growth chart. We can clearly see, wait just a moment, it has just dropped down here to the significant support level. That could potentially be a very good entry point, but you absolutely have to watch out carefully, as it could also drop down again to the last recorded low here, to the intermediate low point. You have to keep in mind there's still another 3.3% possible to the downside here. I would wait to see if it bounces here or if it bounces down there at the intermediate low. But in the long term, if we remove the price, it looks really good. A great company that is growing nicely and is expected to keep growing in the future. That really does look fantastic. What do we have here in the risk analysis? The gross margin is declining. That's not so nice to see. Ideally, it should be rising. Otherwise, all the other numbers look really good and are increasing. The price is 8.34% away from the analyst's target. That's the situation here. Of course, it's not great if the analysts aren't really on board and saying it should go up. There's still 34% to the intrinsic value. It's also critically important to make absolutely sure that the financial analysts set a similarly and appropriately high price target, considering the significant distance to the true intrinsic value of the company. Here we can see they're overvalued. Growth prospects for the current year are negative. That's really bad. And the 5-year growth rate was good. In this case, it's probably that it's still overvalued, even though the outlook is bad, because there's a lot of "I believe in it" behind it. I believe in him, and he's a great financial wizard. He knows what he's doing. But yes, if it goes down here, you can definitely expect the price to drop another 13%. So I definitely would not be buying them at this particular moment in time right now. So you can see it here again, especially in an uptrend. If it drops down into the green area, then you can get a really, really great return, an excess return, you know. If we take a look down here in the green area at the blue line, just like I mentioned with the previous stock, that means don't buy at the blue line in the overvalued area. It's simply overvalued for that. If you look here up until the end of 2026 to the intrinsic value, and the stock always returns to its intrinsic value, you can see it in the past as well. Again and again, it goes back to the white line, no matter where the stock was. So you can expect minus 9% there. And with minus 9%, nobody's going to be happy, right? No one can tell me otherwise. But here, this was a buying opportunity. It was undervalued. And at this kind of entry point, it bounced off, let's say, from this point down here or from here. There, it still had a small margin of safety, and then up to the intrinsic value here. And then during this period, the company experienced growth just about a year and 2 months of 18.5%. And the capital in your portfolio, however, increased by 24.2% because you bought a stock with a 3.29% margin of safety. And when you sold here, it was at minus 1.35, so it was a bit overvalued. That's what makes the difference between 18.5 and 24.2%. With other stocks or companies that grow even more, of course, it's even more extreme.